Welcome to Chapter 8, and in this chapter we're going to talk about depreciation and the sale of business property. What is depreciation? And my hope is that you'll remember a little bit from your prior accounting classes, which will certainly become useful at this point. I think depreciation often is misunderstood by students new to accounting because they think about it in the way that the term depreciation may be used commonly in a layperson's terminology. In other words, they may think of it as wear and tear or the physical deterioration of a business asset. And that is not what depreciation is. What depreciation is a method by which we allocate the cost that we pay for an item when we acquire it over the item's useful life, and how we then expense that item on a yearly basis depends on the method of depreciation that we're using, and we'll talk more about that in a minute. So just to recap, if we buy a piece of machinery or something for our business, with limited exception, we're not going to just take that all as an expense in the first year that there are some provisions that allow us to do this, but in general terms, we're not going to expense the entire machine in the year that we purchase it. That violates to some degree the matching principle, where this machine is going to last us probably years and years and years, and if we take all of the expense now, we're really not matching the expense with the periods that we will be using that machine to generate income. And that's what that matching principle says, is you want to try and match period of income with expenses incurred to generate that income. So the other thing that is often confusing is what is depreciation versus maintenance, and when do we sort of take those? And that becomes really easy when we acquire something. We buy our building, or we buy our vehicle, or whatever it is, then we know what our cost is. But what happens when we make additional investments into this item? Are those part of the capital costs that require depreciation, or are those maintenance expenses that we then can take as an expense deduction in the current tax period? And it is, well, we'll get into that. But first, we're going to just recap, and hopefully this will be review from your prior accounting courses, the various methods of depreciation. We'll start with the simplest, which is straight line depreciation. And all we do for straight line depreciation, it's a simple calculation. We take the cost of the item and we divide that by the estimated useful life of the item. So if we paid $10,000 for an item, and we're going to use that item has a useful life of 5 years, we're going to depreciate that item at a rate of $2,000 per year. This method of depreciation allows us to allocate the cost we paid for this item evenly over this item's useful life. Now we get into this here, Modified Accelerated Cost Recovery System, otherwise known as MACRS. And MACRS depreciation allows us to take the bulk of the depreciation expense in the earlier parts of the item's useful life, and under the theory that when we first buy something, we're quite likely going to use it a lot in its initial years and maybe less as it gets further toward the end of its useful life. So by using the MACRS method, we then can take the bulk of the expense in the periods where we're probably generating the bulk of the revenue from, by the use of this item. Now, the MACRS depreciation method is certainly messier than the straight line, and there's rules that have to be followed, and they do change. And as you can see, there's different rules for items placed in service after 1986, which was long enough ago that you're probably not going to run into too many assets that were that you are still depreciating that were placed in business prior to 1986. So first of all, when you're going to be using the MACRS method, you have to determine what this asset's useful life is. And the good news is the IRS has kind of taken that guesswork out of it for you. And if you look at table 8.1 in your textbook, and I can't really hold this up here, you will see, for example, 5-year. And we have cars, light trucks, office machinery, computers, things of that nature. 5-year cost recovery period. And there are other examples there as well. Calculating depreciation under the MACRS method basically says, okay, you gotta decide what this item is: car, furniture, vehicle, or computer, let's say, something like that. Then you determine, okay, what is the cost recovery period? All right, that's 5 years, 3 years, whatever that may be. And so your book provides table 8.2 with the percentage that you are allowed to depreciate of that item's cost over each year of its useful life. Now, you'll notice that the property that has a 3-year cost recovery period has 4 periods of percentages. Similarly, property with 5-year cost recovery has 6 years of calculations. And why is this? Well, you don't, in probably most circumstances, place property in service on January 1 of the tax year, such that you literally used it for the entire year. So what the IRS says is, okay, we know that at some point during the year you're going to start using this item. And so we're not going to let you take a full year's worth of depreciation in the first year of that you have placed this item in service. What we're going to do is we'll let you take half a year of depreciation during that first year, and then you take the full depreciation for the remaining years of the useful life. Then you get another half year for an additional year following that. So basically, for something that's got a 5-year useful life, you're going to get a half year depreciation calculation in year 1, but then in year 6, you're going to get the other half. And so that will basically balance it out so that you will then be able to depreciate that item over its useful life, but you will not be able to take depreciation over a time period that you probably really weren't using the item in year 1. So let's see, moving right along. If you have multiple pieces of multiple items that you acquired that were in the same class of property. Maybe you buy a fleet of trucks, for example, and you buy them all in the same tax year. You can select between using the straight line or the MACRS method. However, you have to apply the same method to all of the property in the same class put into place in that same year. So you can't, for your fleet of trucks, mix and match depreciation methods that you're going to use if you've bought them all at the same time. We're going to talk about a couple of examples, and then I will hop over to the next video. So we've got March 15th, 2019, the Naturatech company purchased bamboo furniture, and the implication, I think, is that it's business furniture. So first question you got to ask yourself after we've determined that it's business furniture is, what is the recovery period? And you can go back to that handy dandy table 8.1 in your book, and you can see that business furniture has a 7-year recovery period. So it then asks, we're going to talk about a couple of examples and then I will jump over to the next video. So we've got March 15th, 2019, the Naturatech company purchased bamboo furniture for $180,000. First, you got to say to yourself, okay, what is this asset? What are we depreciating? The answer is office furniture. Now that we've made that determination, the next question is, okay, what's the recovery period for office furniture? And table 8.1 in your book tells you that that is a 7-year recovery period. So now they want us to calculate the depreciation for the year we placed it in service and the next year. And so basically what we do is we go to, in table 8.2, the 7-year column, and multiply the 180,000 we paid for it by the multipliers for the first and second year. And you will see here at the bottom that for 2019 we multiply that 180,000 by the 0.1429, and then that gets us our year 1 depreciation. And again, notice how much less we get on that year 1 depreciation than we get on the year 2 depreciation using that multiplier, and that's because of the half-yearly convention that is being applied here. And so we will actually be able to claim a depreciation expense for this item over 6 tax years, because we've got a half a year, or excuse me, 8 tax years, because this is 7-year recovery period, because we will get half a year in year 1, and then in year 8 we will take the other half at the end. Now we've got, on February 3rd, the Luminex PLLC bought a radio frequency identification inventory control system for $12,000. What is the recovery period? Well, it's technology. Things change. If you look at your table, you will see that we've got basically computers, things like that, 5 years. And frankly, you'd be lucky if it's not obsolete before that. But anyway, IRS tables tell us 5 years. What are we going to take for 2019 and 2020? So again, we've got the half year in the first year placed in service, and then we take the full year depreciation until we get to the year beyond, year 5, where we can take the other half of the year. So we go to our table under the 5-year, and we see that we can take 0.2 or 20% in year 1, and then 32% or 0.32 in year 2. Oops. And so I'm going to stop this video here and hop on to the next video to talk about mid-quarter conventions.